Welcome to the Explainer. Okay, so the stock market keeps pushing higher and higher, but something just feels off, doesn't it? Today we're going to decode the hidden forces that are pulling the market in two completely different directions, creating a rally that feels, well, incredibly risky.
So let's just start with the central mystery we're looking at. On the surface, everything looks great. The market is rallying. But underneath, there's this real sense of tension, of instability. So why is that? What is the market really trying to tell us right now?
All right, here's our game plan. First, we're going to look at the shaky foundation of this rally. Then, we'll meet the two big opposing forces, the human vol sellers and the automated systematic funds. After that, we'll see how retail investors are kind of caught in the middle of it all before we put everything together for the final big showdown.
Okay, let's dive right into this first piece of the puzzle. What is it about this rally that feels so different?
Well, the analysis on this is pretty clear. You've got this entire market rally, but it's really being propped up by just a tiny number of those mega-cap AI-related stocks. You know the ones. This extreme concentration, it's a huge red flag for a lot of people, and is creating this deep sense of unease. It just doesn't feel like a healthy, broad recovery. It feels more like a very narrow, very crowded bet.
And look, this isn't just some vague feeling people have. There are actual, concrete signs of stress right under the surface. Funding markets are getting tight, which brings back some bad memories, what the source calls scar tissue from recent corrections. You're also seeing dealers shifting a ton of resources just to fund this frenzy in stocks, which can create its own weird feedback loops. But maybe most telling of all, the VIX, the market's fear gauge, is just refusing to go down. People are still paying up for protection even as stocks go up.
So now let's meet the first key players in this whole drama, the volatility sellers. Think of them as the market's traditional calming force.
But before we can really get them, we have to know what they trade, and that's volatility, often measured by the VIX. You can just think of it as the price of insurance on the market. When fear is high, the VIX is high. When everyone's calm, the VIX goes down. Simple as that.
So a great way to think about these vol sellers is that they're the market's firefighters. It's their job to rush in when things get scary. They've been conditioned for years to step in and sell that now expensive insurance, those options, to collect the income. And that action in turn helps calm the market down. It's become a reflexive, almost instinctive thing for them.
And this quote, this pretty much sums up their entire playbook. It's a simple, predictable script that's worked for a very long time. When the market dips, you buy stocks. When volatility rips higher, you sell it. This pattern has made them a lot of money, reinforcing the behavior over and over. They really represent that human, opportunistic element of the market.
Okay, but here's the twist. There's a really powerful counterforce at play here, one that doesn't run on instinct or greed or even experience. Nope, it runs on pure, cold code. We're talking about the market's robots, systematic funds. These are just giant automated trading strategies. They are not trying to be heroes. They're not trying to make a quick buck. They just follow a very strict set of pre-programmed rules designed to do one thing, control risk. And they do it without any emotion at all.
And right here, this is where you see the huge conflict at the heart of all this. You've got the human vol sellers, whose goal is to earn income by selling insurance when volatility is high, and then you have the systematic funds, whose goal is to manage risk by selling stocks when that exact same volatility gets too high. These are two completely opposite reactions to the very same event.
This is absolutely crucial to understand because these funds, they can create a really dangerous feedback loop. Here's how it works. A small market dip happens, which causes volatility to tick up. That rising volatility then triggers their automated rules, which forces them to sell stocks to lower their risk. But of course, that selling pushes the market down even more, which spikes volatility again, triggering even more selling. You see the problem?
And let's be clear, we are not talking about a small player here. The scale of this automated selling is just massive. The source estimates that just one type of these funds, the volatility control funds, have already been forced to dump over $100 billion in U.S. stocks in just the last month alone.
Okay, so let's bring in our next character, the retail investor. Because their actions, their behavior, it perfectly captures the anxiety that's flowing through this entire market.
The analysis uses some pretty colorful language here, but it really gets the point across. Retail traders aren't just in this rally, they are leveraged up to their eyeballs, biblically stuffed to gills, making huge bets that the market is going to keep going up.
But this is where it gets really weird. It's a total paradox.
At the exact same time they are all in on the market rising, they are also spending a ton of money on VIX products, which is basically buying insurance against a market crash. It's like they're flooring the accelerator and frantically buying car insurance at the same time. This kind of behavior, it just screams uncertainty.
So what happens when you bring all these pieces together? What happens when human habit slams into mechanical rules? Well, we get the final verdict on just how stable or unstable this market really is.
And when you put all the numbers together, the analysis points to a really dangerous imbalance. The forces that are set up to accelerate a rally are just dwarfed by the forces that are set to accelerate a pullback. The mechanical selling pressure just waiting in the wings is now way, way bigger than the buying pressure.
And honestly, this is the key takeaway from the whole thing. The very structure of the market is now coiled for a much faster, more violent move down than up. Think of it like a spring that's been squeezed tighter and tighter. There is way more energy waiting to be released on the downside. So what you get is this ultimate tug-of-war. On one side, you have the automated, systematic funds. They are primed and ready to unleash billions in selling pressure at the first sign of real trouble. And on the other side, you have the human vol sellers, conditioned by years and years of success, who are still just reflexively stepping in to buy the dips, betting that this time is no different from all the others.
And that leaves us right here, with the one critical, unresolved question that's going to decide the market's next big move. You have emotionless machines that are programmed to sell into weakness, and they're facing off against conditioned humans who only know how to buy it. One of them has to be wrong. The only question is, which force breaks first?